एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता
it's very heartening for us in SIRC that we're able to conduct such programs with eminent speakers, and we took a very conscious decision that for these much in need programs, we'll do it online so that more people can benefit from the experience of the speakers who are coming in. And it's even more heartening that the sessions are extremely interactive and members are able to get all their doubts clarified. And I would also like to place on record here that the queries which were shared with us by a very senior chartered accountant on tax audit has also been shared with the speakers, and they are also addressing these queries. And I think Mr. G.N. Ramaswamy will also be addressing the queries. So I want to place on record here my appreciation to CA G.N. Ramaswamy, who is known as GNR to all his friends. He's a very senior chartered accountant and also, most importantly, a photographer who's associated with the photographic society, and he takes his photographs are more like paintings rather than photographs. So I'll give a quick introduction of CAGN Ramaswamy. He is a fellow member of the ICAI, a DISA of ICAI, and has completed post-qualification courses of ICAI on IFRS and international taxation. He is a registered insolvency professional, having enrolled with the IBBI, and also a registered valuer for securities and financial assets with the IBBI. He is empaneled as an independent director in the data bank maintained by IICA and possesses more than 30 years of post-qualification experience in servicing large and medium-sized clients in the areas of statutory audit, encompassing application of financial reporting standards, apart from advising clients on strategies for governance, restructuring, acquisitions, and related valuations and tax implications. He possesses wide experience in listed companies and other entities in private and public sector across banks and financial sectors, manufacturing, trading, plantations, consumer products, logistics, hospitality, healthcare, and media. And he's a fellow member and an executive committee member and vice president of the Society of Auditors. And he has presented papers in various seminars, study circles, and meetings organized by ICAI, ICSI, and SOA. Traveling and reading inspire him, and he's a passionate photographer. And currently, most importantly, he's the president of the Photographic Society of Madras, one of the oldest photographic clubs of the world. As I was telling CAG and Ramaswamy, I will not be able to be there during the closing session, but I'm sure that he'll do a fantastic session today, because he's been associated with us on various topics. And when I reached out to him, he immediately accepted. Thank you once again, GNR, for accepting our invite and sharing your knowledge today. I hand over the proceedings to you. Thank you.
Thank you, Revati. Thank you.
Yeah, thank you. Yeah.
Is my screen visible now?
Yes, sir. Visible, sir.
Yeah. So, good afternoon, friends. Thanks for giving. I thank Revati and other committee members for giving me an opportunity to take this session on tax audit. I have been allotted classes 14 to 18 and 30 to 44. So totally 25 classes I'll be covering this session. So I've been given a slot of 2 hours. I'll try my best to cover all the areas, whatever will be important for the members in practice particularly. So during the course of the presentation, if you have any doubt, you can type those things in the chat box. So I'll answer at the end of the session. If the time doesn't permit to give all clarifications, I'll share the reply to all the participants by mail in a day or two through the support of SIRC. In fact, I received a couple of queries already from some senior members, which I factor and I'll give the clarifications post my presentation. So today I'll be covering these classes: class 14, that is on inventory; class 15 on capital assets, current and stock in trade; class 16, that is amount credited to profit and loss account; 17 is regarding transfer of land or building or both; 18 is depreciation; 30 is amount borrowed on hundi; 30A, repayment adjustments on transfer pricing, 92CE; 30B is also transfer pricing, 94B; and 30C is impermissible avoidance agreement, 96; 31 is loans on deposit; 32 brought forward losses on depreciation allowance; 33 is chapter 6A reduction; 34 TDS; 25 quantitative particulars under 35; 36A deemed dividend; 36B is buyback of shares; 37, 38, 39 is on audits, both cost audit, central excise and the Finance Act; 40 is turnover, gross profit ratio, etc. And 41 is demand raised; 42 any return to be furnished, 61 and 61A; 43 is obligation to file report under 286(2), and 44 is GST reconciliation. This is a new one. So these are the topics I'll be covering. Considering the importance, I'll be spending some more time on certain classes and lesser time on certain classes. If we have any doubt on any particular topic, please free to raise a query in the chat box. It will be easy for us to look into an answer, or you can raise your hand once I complete the session. It will be possible for the moderators to unmute you so that you can raise the question yourself. With this, I'll enter into the presentation. Hope my communication is audible to all of the participants.
Yes.
Edwin, please, can you confirm? The sound is all right now?
Hello. Yes, sir.
Yeah, yes, fine. I got this reply. Fine, thank you. So the first class 14 is a method on valuation of closing stock applied in the previous year. It's not the common area. See, we will be doing tax audit both for companies as well as non-corporate. For companies, not an issue because we'll be doing a thorough audit under the Provisions of the Companies Act, following the principles of accounting standards and also following the guidelines prescribed under various statutes. But when we come to the unstructured entities like firms or smaller property concerns, we'll have challenges when we do the valuation of inventories. But the clause is applicable for all. So whether it's a company listed or unlisted, or it's LLP or a partnership firm or a sole proprietor, we need to comment on this clause to the extent required. They are talking about method of valuation of closing stock. Closing stock includes all items of inventories. So we need to comment on finished goods, raw materials, work in progress, materials, maintenance supplies, consumables, loopholes, whatever may be. So we should not confine ourselves only to the finished goods. We have to comment on all the type of inventories. So we need to comment what is the method of valuation, whether it is valued at cost or market value, which is lower, or what is the basis of valuation, that is more important. So method of valuation is more critical as far as this clause is concerned. So we need to get a complete list of inventory indicating the basis of valuation for reporting. For example, in the case of companies, obviously there will be a proper verification process. It depends on the size of the company and nature of the inventory. Some companies will do annual valuation verification, some companies will do a quarterly verification, some will do a perpetual verification. But for smaller entities, always the verification will happen only at the year end. So if it happens on 31st of March, it is very good. So we can take cognizance of the items verified and arrive at the closing stock value. If it happens at a later date, for example, in the month of June or August, when we do the tax audit, then we need to back work to arrive at the book stock as at 31st March. It is a cumbersome process. So always it's better to educate our client to conduct the physical verification either the closing date or 1 day or before or 1 day after the year end. So it is easy for us to complete the documentation. So we need to also check whether the method of valuation has been consistently followed. We should not change the method of valuation from 1 year to other, either from FIFO or LIFO or weight average. Whatever we follow, we need to consistently follow the same method of valuation so that the presentation of the financials will be fair and proper. And we need to review the components of the cost on a thorough basis to ensure there is no over or undervaluation. For example, if you include some additional items in a particular year, the profit will boost up, or if you remove some of the components from the cost, the profit will reduce. So we should not use this as a methodology to distract the profit for the year or the fair percentage of the P&L. So this is the most important aspect. And further, ICDS, we need to comment on the basis of valuation. So AS2 and Ind AS2 both prescribe only exclusion method, but 140A requires inclusion method. So the adjustments wherever required and 140A to be given if you follow the exclusion method. For example, the companies follow in AS2 or listed companies follow in AS2, though prescribes only the exclusion method. That is whatever the input tax that will be parked separately in a separate account, and from there we will be availing the credits whenever the sales happen. But for ICDS and 140A, we need to include the GST or whatever component taxes arriving in the cost, but it's not going to affect your valuation per se or the GP margin, but the presentation differs. So if the exclusion method is followed, then we need to disclose the details in the respective clause. So cost of purchase, as I told you, ICDS 2 talks about inventory. The cost of purchase shall consist of the purchase price, including duties and taxes, freights, inward, and other expenditure directly attributable to the acquisition. So to bring the material to the present state. If it is a raw material, normally the freight and transport will be there, loading, unloading charges will be there. Suppose if it is the semi-finished or finished goods, some value addition will be there because the cost of production will be added, depreciation will be added, so many things. And similarly, there will be trade discount, rebates, and other similar materials has to be directed from the cost to arrive at the landed price. So this is the fundamental basis. But when we come to AS2 or Ind AS2, the cost of purchase will consist of purchase price, including duties and taxes, other than those subsequently recoverable by the enterprise by taking from the tax authorities. For example, GST obviously will be availing input tax credit. So this tax GST cannot be loaded to the cost of materials. So obviously, all the companies wherever there is a GST element, they will park the GST input credit in a separate account, and from that account they will be availing that credit as and when the sales happens. So ICDS 2 and Ind AS 2 or AS2 differs in this extent, but all other components are same. Freight inwards, other expenditure directly attributable, trade discounts, rebates, etc. are all same. The ICDS2 prescribes inclusive method, AS2 prescribes exclusive method. Most of the companies or the firms LLP will follow exclusive method while preparing the financial statement. That is well accepted because all the firms and LLP also have to follow the AS2. Obviously, they have to follow only exclusive method because otherwise they will be deviating from the requirements of the standard. That is not accepted. So whenever there is a requirement to present under exclusive method as per the standard, then we need to analyze and give the details of the variance if the inclusive method is adopted. So inclusive method is not permitted both as I told you AS2 and 2. So accordingly, the adjustment in 140 will not have any impact on the trading account. So this is only a method of accounting. See, one part you will be parking this item separately. Other thing you will load into the stock purchase cost and obviously remove whenever there is a sale happens. So the impact on gross profit will be the same under both the method. But for the purpose of the tax authorities, we need to give the working in our tax audit report. So in case of any deviation method, they are asking us to give serial number, particulars, increase in profit, decrease in profit. So this is only for statistical purposes. We need to give these details because 1 year there will be increase, other year there will be decrease if that is not paid on time. So as an auditor, what are the actions points we need to take care while commenting on this class? We need to study the procedure followed by the in taking inventory or closing stock at the end of the year and obtain the method of valuation thereof. So we have to see whether they are doing the verification at the year end or immediately after the year end, and we will roll forward. And what is the basis of valuation? Whether you have to examine whether the method of stock valuation is followed consistently from year to year. This is more important because some companies or some firms To just to increase or decrease the profit, they will do some adjustment in the method of stock valuation. That is not permitted. As an auditor, we need to check not only the current year valuation, we have to compare the same with the previous year valuation to see whether the basis is same and all the cost particular components of the cost are one and the same. And we need to verify the stock valuation statement to correctness of the method of valuation. So this is mathematical calculations to check whether the numbers are proper and from the base records. So compliance with applicable ICDS 2 and AS2 regard methods of principles of inventory valuation, I already explained. So let me not go into that further. And we need to check whether the proper adjustments are made in the statement of total income or difference arising out of GST or any other steps where the exclusion method of accounting is followed. So obviously, whenever there is exclusion method is followed, we need to see whether the taxes have been paid subsequently. So if not, then we need to give necessary adjustments in the statement of total income. So ensure that if an deduction is claimed in for any tax or any fee, relation stock by way of debit in the profit and loss account, either the year or the year-end report, adjustment of the same should be made in the manner so that no double deduction is claimed for the same expenditure. For example, some year if you are claimed on payment basis, subsequently the same item should not be claimed in the subsequent statement of total income. As an auditor, we need to check and confirm that there is no duplication or double deduction. And when you come to the valuation or components of the cost, we need to add the overheads in inventory valuation. Normally, for manufacturing companies, we will be adding a low portion of depreciation or fixed cost in the inventories. Normally, it has to be done based on the normal level of production. For example, the company's normal level of production is 1 lakh units. We need to quantify the fixed cost per annum and divide by the 1 lakh units. Suppose the production is only 80,000 rupees, we can't divide by 80,000. We have to factor only 80,000 because the balance 20,000 is always the charge of the profit loss account. Then the excess also is charged to P&L. So change in method of valuation, we have to see whether there is any change in method of valuation, and that need not be reported under clause 14. However, whenever there is a change in the method of valuation, then the reporting is required under clause 14, that 13, that we would have been already covered. Valuation of inventory in case of dissolutions. Whenever there is a dissolution of firm or LLP, then the valuation has to be only on net residual value, not at cost. So this is one of the things so that the fact to be cost to be apportioned properly, that the profit for the year till the date of dissolution is apportioned and taxed correctly. This is one of the requirements. Now come to net residual value. See, inventory shall be written down to net residual value. That is a common understanding. So we can value the inventory at cost or market price, whichever is lower. So whatever you are going to realize by selling this product, if suppose the value realization is lower than the cost as per the books, then we can write down the inventory. That is permitted. However, normally the raw material will not be written down. Normally it will be always the carried cost. Suppose if the raw material is used for manufacturing activity and after including the cost, suppose the final selling price is will not realize the full raw material value, then to that extent we can write down. That is permitted. And similarly, whenever we are doing that valuation of inventory on cost or market value is lower, we need to do on item basis or certain group basis. For example, certain products, for example, the company is making floss. All the floss will be getting same relative value per unit. So we can aggregate those items and value. But we can't add X and Y and arrive at a relative value, which is not permitted. And similarly, we need to take into consideration the exchange fluctuation of price directly related to the occurring in the previous year, and whenever there is a change, that also to be factored. As I told you, we can't write down the inventory below the cost in respect of materials. As I told you, if the final price of the finished product is going to realize lesser, then to that extent we can write down the value of the base materials. So what are the comments from QOB as regards this clause is concerned? Method of valuation has not been reported under clause 14A. See, most of the case, no, they will say at the cost without giving itemized breakup. See, as I told you, inventory consists of various items: raw materials, frozen spares, consumables, maintenance, supplies, finished goods, etc. I think some, etc. So we need to give the basis of valuation for all items, all line items. We should not say just one line item, inventory at cost or market value. That is not correct. You need to give the method of valuation for all items individually. For example, for raw materials at cost, or working progress at what are the price basis, finished goods at the cost or market value, which is lower. Like that, we have to give all the details. So second one is valuation was done as per AS2 or in AS2, that is exclusive method was followed. But in that case, they have not commented on 140A. So this is one requirement. We need to compare and have the reconciliation ready and comment on 3CD in the, under this class. But there may not be any impact in your 3CD if the process is followed. But in the reporting, is one of the observations from QRB. And reporting for the method of valuation of implied in the previous year to be reported, but most of the cases they have not given that comment properly. In some cases, they would have mentioned just refer accounting policies, but in accounting policies also may be silent regarding various components. So we need to check whether all the required information have been given either in the tax audit report or in the financial statements as required under this clause. Now come to clause 16. This is regarding conversion of capital asset into stock in trade. For example, the company is holding certain immovable property and under the property plant and equipment. Subsequently, they decided to develop it for real estate or whatever purpose may be, and they say it is not fit for treating as a property plant and equipment, and they want to move it to stock in trade. In those cases, we need to give the details in the tax audit report. Obviously, there will be a financial entry in the books of account by crediting your PPE and debiting the inventory or whatever may be. In those cases, we need to give the details in our tax audit report. We need to give the description of the capital asset. What is the date of acquisition and what is the cost of acquisition? For example, if it is building, the books will carry a return on value. But in this clause, we need to give the cost of acquisition. So we have to go back to the original year and we have to ascertain what is the exact cost. And in addition, we can give what is the carrying value also. There is no harm. But we need to give both the date of acquisition and the cost of acquisition and the amount at which the cost is converted to stock in trade. So whenever they do the conversion, or they will be doing at a fair market value on the date of transfer. So we need to give that details also, or if it is transferred only at the book value, that fact also to be given in this clause. So while giving these details under this clause, we need to keep in mind the provisions of section 247, 40B2, 47.4, 47.5 and 47A. So there is nothing but the transfer or impact of capital gains when it will be taxed, whether it's a transfer or not. All these things to be kept in mind so that the information furnished in the tax audit report accurate. Please note that whenever we convert a stock in capital asset into stock in trade, it will not be taxed in the year of transfer. It will be transferred only the year of ultimate transfer. So not that is not when we pass the book entry from transferring from capital asset to stock in trade. It will be taxed in the Income Tax Act only in the year it is ultimately sold by the entity. So till such time it will be notional capital gains. It will be parked in the books that will be ultimately paid at a later date. So cost of acquisition is the must. This is one of the comments in QRB. Most of the cases, they'll just put that it is not ideal, it's not practically possible because the capital asset, obviously, there will be a parent document. We can ascertain the cost easily. We need to give the cost. So as I told you, even for depreciable asset, we need to mention both the date of acquisition and the cost of acquisition. That is a must. The excess of sale price over fair market value on the date of transfer will be taxed as business income. So once you transfer, for example, the cost of the fixed asset is 1 lakh, and the date of conversion is on suppose 1st April 2025, it is around 5 lakhs. The 4 lakhs is the capital gain portion, and the 5 lakhs is sold at a later year 6 lakhs. The 5 to 6 lakh difference 1 lakh will be taxed as a business income, and this 4 lakhs will be taxed as a capital gain. So what are the areas, what are the actions we need to take here? So we need to get a list from the SIRC regarding all the assets converted to stock in trade with the year-end report. So normally from the fixed schedule itself, we know our investment schedules from investment to stock in trade or fixed to stock in trade, or some cases they'll be parked under the capital gain process. From that they would have transferred to your inventory. So those details we need to get from the company, and we need to get a declaration that all other assets wherever parked is not only a capital asset, not a stock in trade. And we need to review the fixed schedule correctly, particularly with regard to the asset discard or sold, to ensure that there are no items which are converted to stock in trade is grouped so that it will be disclosed properly. And we need to check the compliance of ICGS 5 and AS10 for arriving at the cost of self-control asset, because whenever we self-generate assets, there will be a lot of additions, expenditure incurred by the assessee themselves. So those things will be attributed to arriving at the proper cost. Some cases we need to get a valuation report from the experts because certain assets would have been capitalized based on the valuation reports. In that case, we need to obtain the report and examine it, and we need to give the disclosure appropriately. and we need to check the journal entries cost in the books of account at the time of conversion, so that it will be easy for us to explain at a later date, and take a copy of those journal entries also. And we need to ascertain the value at which the asset is converted in stock in trade. If the if a value other than the carry value is recorded, and we need to check on the base what basis they recorded the value. Normally they will do the fair valuation. If it is removed properly, they go for a gate value, or they'll get a valuation report and do the conversion. So we need to have a proper documentation for that to decide what is the value at which it is recorded. It is not only for this class and also for the certification of financial statements, because this entry will affect your financial statements also, because we are moving one item from your non-current assets to current assets. So obviously we need to have the proper working paper. If it is company, obviously those details will be recorded and available, obviously. But for LLP firms and individuals, then we need to have these details in record and verify properly, so that there will not be any misstatement in the financial statements. The next clause is clause 16. This regarding amount not credited to a profit and loss account. The department wants to ensure that all items that are subject to be taxed are taxed properly. So in that regard, they want auditors, tax auditors, to comment if there is any amount which is liable for taxation is not included in the statement of total income, then we need to comment on this. The first item is regarding the items falling under scope of section 28. Section 28 talks about what are the items taxable. If any item taxable under section 28 is not credited to the profit loss account, we have to comment those with details. The pro forma credits, drawbacks, refunds of duty or customs or excise or sales tax, refund of sales tax or value tax, including GST, where such credits, drawbacks or refunds are admitted and as due by the authorities concerned. Normally, what will happen? Here only the problem arises. Wherever the department confirms that you are eligible for a refund, the refund will come in a subsequent year, but they will quantify the amount and they will pass the order. In some cases, no, the amount also will be refunded to the entity, but the entity will credit that amount in the liability account, not to the credit of profit and loss account, just to avoid paying tax. So this is not correct. So now, as the auditor, we need to review not only the orders, we need to check the credits in the balance sheet items to ensure that those credits are not relating to the refunds credited by the assessing authority. If so, we need to comment in this clause. If it is already credited to the profit and loss, there is no issue. Then we need not worry about that. If it is not credited to the profit and loss account and parked in your balance sheet as a liability, or wherever the order is quantified but not accounted in the books of account, then we need to comment on this clause. Escalation claims accepted during the previous year. See, the company who are doing project work, normally there will be some cost plus contracts, and there will be some escalation claims also. But escalation claim, the revenue cannot be recognized as and when on a suo motu basis, because other party has to agree. Then only we can recognize the revenue to the extent that is receivable. For example, you are making a claim of 10% extra over the original invoice value, but the customer may accept only 5%, or after negotiation is only 3%. It depends, it varies, and it takes years. It will not happen within a short period of time before the closure of the financial year. So the transaction happened in 22 or 2020 may crystallize and confirmed only the current year. In that case, we need to ensure that amount has been credited to the profit loss account if it has accepted during the year. If not, then we need to comment that amount, though accepted by the party, is not recognized in the profit loss account, and we have to quantify the nature and the amount. Any other item of income. So already they covered 28, all the credits and escalation, etc. If at all anything other than this, because now in the present scenario, the business is conducted in so many ways. So there can be any other chance, any other income that may be subjected to profit loss account credit but not accounted, then we need to comment on that. Capital deposit. This is only for information purposes, because merely mentioning the amount in this class will not be added to the statement of total income, but to check whether that any part of the capital receipt is taxable in the current year, the department wants to confirm is there any credit amount not credited from the account. I'll go into these aspects in detail in the subsequent slides. So the action points is, as I told you, section clause A covers all items which are not credited to profit loss account. So that we need to comment. Once an item is commented in clause A, we need not repeat those clauses in the subsequent clauses, or vice versa. If suppose a GST or VAT, etc., if you are commenting under clause B, or escalation claim you are commenting in clause D, we need not comment under clause A. So clause D talks about any other income. So we need to see whether the revenue recognition principles are AS9 or Ind AS 15. So we have to keep in mind, if at all any amount which is subject to be credited to profit and loss account not done, then we need to go to the clauses. For example, some of the items, though the income will be credited to the expenditure account. It may not be direct credit to the P&L, but by versa, indirect credit to the P&L account. In those cases, we need to mention as a footnote that though amount received has been credited to the certain expenditure account, and accordingly there will be an addition by the asking of. Regarding capital receipts, obviously the capital grants by the government or promoters contribution, what may be, we need to give the details. Obviously, if it is a government grant capital investment subsidy, we will be credited to the fixed assets, and only the depreciation will be claimed only on the net amount. If it is not done, we need to give the details here. Even if it is done, we can put a footnote that the capital receipts have been credited to the fixed assets account under this amount. Compensation for surrendering certain rights. Obviously, whenever you are surrendering certain rights, you will be getting certain income. The companies will park that under directly in reserve surplus or directly to the liability account till they reach the finality, but it's not correct. We need to quantify that and account it properly in the financial statements. If not done, we need to disclose here. Profit on sale of fixed assets, obviously, we credit to the profit loss account. If not done, we have to disclose here. Refund of non-receipt, refund of deposit, or feature of deposit. So, for example, you receive certain deposit from the dealers or customers. After some time, we have decided to forfeit that amount. So that amount will still lying in the liability account. That's not correct. That has to go to the P&L. If not done, we have to comment here. Government grant, I already told you. Fixed assets has to be shown as a reduction. So obviously, that is only a disclosure purposes. Equity or loan or borrowing are not required to be stated under this clause because that is totally outside purview of capital reserve. It is not liable for taxation. So in the course of audit, if the auditor finds out any 41 credit, for example, any amount written off in the previous year subsequently recovered, the client, if it's parked under trade receivables as credit balance, that is not correct. Whatever claimed earlier in the tax has to be offered to the tax in subsequent year on receipt. So if not done, we need to report that those details under this clause. Clause 17, any land or building or both transferred during the previous year for consideration less than the value adopted or assessed by the government authority. For example, that is nothing but the guidance value. So if any amount has been transferred for consideration less than the guidance value, then we need to give the details here. 43 CA talks about inventory items, that is not a capital item. 50C talks about removed property. So we need to give the details of property, consideration received or accrued, what is the value adopted or assessed or accessible, whether the provisions of second provision to subsection 1 of 43 CA or fourth provision to clause 10 of 56. We have to say yes or no. If yes, we have to give further details. See, there is a clause that anything up to 110%, there is no issue. So only if it is more than that percentage, then we need to be taxed. So we need to worry about that. The factual information. Suppose the guidance value is 1 crore, the company is transferring the asset for 50 lakhs, then we need to give this because the different 50 lakhs will be taxed by the tax authorities by invoking the provisions of section 43 CA or 40C. So the tax auditor need to give the details of property details. We need to give the detail of consideration received or accrued, and also we need to comment on the value adopted for stamp. So regarding QRB under this clause, it was observed that certain cases reporting under this clause was done when consideration was received or transfer of an asset are both value adopted by 43 years same. That is, the guidance value was the amount considered in the documentation also. For example, 1 crore is the guidance value. In the sale document also 1 crore is mentioned, but in spite of that, they mentioned this clause. It is not required. Wherever there is a variance only, we need to comment. Clause 18, always we'll have some challenge in this clause, though it is very simple, but it has complications also. Depreciation allowable under the Income Tax Act. So we need to give the details of block of assets or description of asset. If it is a small entity, only a certain description, few assets will be there. If it is a larger entity, we need to see the block of assets with a lot of items, 10 items. And we need to see the rate of depreciation. The third one is actual cost or WDV, as the case may be, because if the first year there will be actual cost, subsequently we will be claiming depreciation, and opening balance will be the WDV. So we need to do the adjustments as required under 115 BAA and 115 BAC. It is over 2021 and 24-25. Now the years are over, so we need not bother about this clause. Adjustment made to the return value of intangible asset due to excluding value of goodwill of a business or profession. See, previously what will happen now, to gain tax benefit, they will do certain mergers or demergers and create a goodwill in the books of account. So they will claim depreciation, amortization on this goodwill, goodwill item. But now subsequently the Finance Act has been amended, and depreciation is not eligible for intangible assets. I just put my phone on silent mode, please. Sorry for the inconvenience. We goodwill on this type of internal adjustment is not permitted. Only the acquired value is balancing figure. So what is the cost minus depreciation and the adjust value? And there may be some transfers, mergers or demergers will happen during the period. In that case, there will be some additions or deletions from the depreciation statements. So for that, we need to have the documents properly available. In case of mergers, there is no issue. If the entire companies come, we can simply add the WD of that entity into the WD of this company or entity. But if it is a partial demerger or partial merger, then we need to rework or split the previous year IT depreciation statement into 2 or 3 components and take the correct value. For that, we need to work out the depreciation on asset wise. It is a cumbersome process, but we need to do that. Then only we can certify the amount correctly under this list. Depreciation allowable is obviously the responsibility of the auditors to quantify the amount allowable as per the provisions of the Income Tax Act, and the balance figure is the WDV at the end of the year. So we need to give the depreciation of a block of assets. So the broad area of classification is more important, whether it's the 15% depreciation, 40% depreciation, or 60% depreciation, or 10% depreciation. We need to identify the same asset may have a different rate of depreciation for different entities. For example, the computer or one entity carry a higher rate, but the computer is attached to machinery, it will carry the rate applicable to the plant and machinery. Similarly, the furniture pictures or it may be certain items. We need to evaluate it from the assessor's point of view and take a conscious call and provide any litigation of later data. So classification of asset is the most important thing when you certify on this thing. So actual cost of depreciation, WDB is not a major task. We can do that. And date of acquisition is more important, and date on which it put to use, because income tax depreciation is allowable only from the date it is put to use. So we should not just put the date of acquisition, because, for example, so purchasing a machinery, it can't be put to use on the same day. It requires some installation, it requires some certification from the regulators, various components are involved. So unless all the processes are complete and the asset is ready to be used, we can't claim depreciation. So the date of acquisition as invoice is not relevant. The date of putting it to use as the engineer certificate is more important in those cases. So we can claim depreciation only from the date. Though the tax says only more than 180 and less than 180, for the classification itself, we require those details properly. Additional directions, I already told you, we'll have challenges only in case of merger, demergers, or any combination of the organization. We need to have proper documentation for that. Similarly, we need to do certain adjustments of our foreign exchange, convert credit, etc. Because on all items, certain items, we are not eligible for GST credit. Then in the case, we'll be claiming depreciation. Certain things we will be claiming input credit. Those things we have to exclude from their addition. Similarly, whenever you are transferring asset, we need to remove those things from the block, the sale value, because for example, for books, we will be claiming depreciation over a period of 3 years, but for income tax, the rate of depreciation may be 10%. Even though it is fully depreciated in the books of account, we'll be claiming depreciation in the IT statement. So there will be some gaps. We need to have workings and supporting for that. I received a chat and just see what it is. I received a comment that there is audio is not stable. Is it for everyone or only for some? Can someone come on, please? Is my audio is okay?
Yes, voice is okay, sir. Video little bit
I'll
low.
switch off the video then, because maybe some internet issue.
Okay, then.
Now is it okay, please?
Yes, yes, okay. Audio is okay, sir. You can proceed.
Fine, thank you. So we need to check the applicable rate of depreciation of income tax rules. We need to check the rate on a year-on-year basis, because there may be some amendments. We'll be claiming some additional depreciation in the first year. So we would have put that instead of 15%, we would have put 38% as the rate of depreciation. Subsequently, we should not copy paste next year, because the base rate again comes to 15%. So we need to be extra cautious while working on the depreciation amount also. So this is suppose, for example, we have the new for the assessee for this year, and we are conducting tax audit for the first time. Though it was done by the previous auditor, then we need to mention the fact in our tax audit report that the opening balance is as per the income tax return and the tax audit report filed for the preceding assessment year. That is more important, because we are not bound to check the accuracy or correctness of the tax audit report of the previous year, because already verified and certified by another auditor. So we need to mention that the opening balance as per the tax depreciation statement certified by us is based on the tax audit report filed by another auditor. Or if it is not subject to tax audit, then assessee would have prepared a depreciation statement. First time the assessee becoming a tax coming under the purview of tax audit means previously they would have filed the return of income with the depreciation statement prepared by themselves, not audited by another auditor. In the case, we have to mention the fact. If there is any mistake or in addition or deletions happens to that, we will not be we will not be questioned, and whatever appropriate adjustment can be done at a later date. But this fact is a must. Please ensure that this is documented properly in the respective schedule. So this I already covered. I don't want to spend much time. If you have any specific query, this depreciation class, I'll answer at the end. I'll move to the next class. So regarding QRB, the observation is mainly on the addition deletions. So they are just mentioning that it's not tallying with the printed accounts. For example, if it's a company or LLP, the audited balance sheet, we will have a depreciation schedule or a fixed schedule. The additions and deletions as per the schedule must match with the tax audit report. If there is any difference, we need to mention, give a reconciliation for that. For example, there can be some difference. For example, foreign currency fluctuations, there may be some adjustments, or certain items, though calculation of books not claimed for tax purposes or vice versa, or certain items moved from one year to another year. Those things we need to give a proper reconciliation under the depreciation schedule itself to avoid any query at related date from the regulators. So it will help the assessing officer to review and do the needful. And similarly, we need to give a separate column for foreign exchange fluctuation so that it will be easy for them to understand. Additions, normally they give the data purchase as a bill. That's not correct. We need to give the data put to use. That is practically it is not possible in all cases, but we need to have the details ready and give that. Deductions also, date of sale reported the same in respect of each item or each block of sold. See, we need to go item wise, not as a total block. That is not correct. So in some cases, they are given the single consolidated amount. For example, in the plant and machinery, as per the audited balance sheet is 5 crores. It may consist of more than 100 items. Same 5 crores will mention in this addition column. That's not correct. We have to give the asset-wise breakup. And for each item, we need to give the date of acquisition and what is the date of put to use. The clause 30 is regarding hundi. Now the concept of hundi is gone because everything is in a different time period. Previously, the hundi borrowing used to be quite common from various financiers. They used to get a loan by way of promissory notes or such other instruments that is known as hundi. So we need, if there is any borrowing on hundi, then we need to give the details of amount borrowed and also the amount due thereon. So what is the amount borrowed and what is the amount ultimately outstanding at the end? We need to give the details. We need to obtain the complete list of borrowing because only the client has to say. Because if suppose they acquire something and group it under certificate class, unless we review the 100%, because we will be doing a sample basis, we need to check and get the details from whether there is only borrowing. So we need to check the correctness and ensure that they are acquired or obtained by accounting check or bank transfer. So there may be some practical difficulties, but there is no other option. We need to get all those details and give a proper disclosure. But to my knowledge, in the last 10-12 years, I have not commented anything on this clause because the concept of hundi is gone. What is the difference between this hundi and section 269? Hundi is irrespective of the amount. We need to comment whether if there is a hundi, even if it's 10,000 rupees, we need to comment. But whether obtained by account wages, but in case of 269, there is a limit of 20,000 rupees. Up to 20,000 rupees, there is no obligation. Anything more than 20,000 only, we have to comment under 269 and 269. That is regarding loans or borrowing. Now come to clause 30A. It is transfer pricing, always challenging. We'll have a lot of litigations. It's better to, if we are familiar with the transfer pricing guidelines, EP Kadirwel has raised hand. Can you unmute him, please? Mr. Kadirwel? Sure, I noted. Yeah, he wants me to go slow. I'll do that. So this is a challenging task. Whenever there is a transaction with any related party outside India, that is associate enterprise under the tax parlance, then we need to ensure that the transaction are at arm's length. For quite some years, there was a domestic transfer pricing also, but subsequently that has been abolished. So now we need to comment only on international transfer pricing. So whenever there is a transfer pricing transaction, that is any transaction related party outside India, then we need to see whether there is any primary adjustments. What is the primary adjustment? Primary adjustment is, suppose, for example, you are selling some items to a foreign party for 1 lakh. But while completing your transfer pricing study and documentation, the fair value is arm's length price is only 1.2 lakhs. This 20,000 is your primary adjustment. So obviously, this amount will be added to your statement of total income. And obviously, as per the provisions of this act, we need to raise the bill on the party and recover the amount within a specific period. If that amount is not recovered, and obviously no interest has to be collected from them. So it is the audit responsibility of the auditors to see whether the transactions entered into by the entity with the related party outside India are at arm's length. If so, if not, whether the difference amount has been properly accounted in the book of account. If not, we need to give the details. If accounted, whether the amount has been recovered within the specific time. If yes, no issues. If not, we need to check whether the interest income has been recognized on the excess money. That details to be furnished in the tax audit report under clause 38. So for this purpose, we need to check the primary adjustments with various other details. So this is more relevant for making secondary adjustments. Secondary adjustment is nothing but the interest I told you. So the primary adjustment is the amount, differential amount between your accounted value and the fair value or arm's length price. And the secondary adjustment is if suppose this amount is not recovered within the stipulated time, what is the additional amount to be offered for taxation? So it can be the primary adjustment can happen in various factors, either by the assessee themselves, because normally the assessee will fix the price and they will do the accounting based on that. At the year end, they will do the comparative analysis with the peers basis of transfer pricing documentation, arrive at whether this pricing adopted by them is fair. Suppose the fair valuation as per our accounting is 1 lakh and basis on the transfer pricing documentation is 1.10 lakhs or 90,000. If it is 90,000, no issue, because obviously we have offered more for taxation. If it is less, then it will be detrimental to the government. Or if it is fair, then there is no issue. So if there is a difference, assessee themselves pass a debit note or credit note as the case may be. Or during assessment, assessing officer will quantify the amount, because at the time of scrutiny, they will review all the details and check and confirm, and they will may do an addition. In that case, that is done by the assessing officer. Or assessee themselves can go to the advance ruling. So they can go to the department and ascertain what is the fair price. Once that is quantified, they have to follow that. There will not be any dispute. So that is also being practiced. And what is the safe harbor rules? The department has given certain window under section 92 CB to determine the fair value. So all these things are the variations. Similarly, there may be some agreement, mutual agreement procedure to avoid DTDA. So wherever that is step, that also can be taken for. So these are the areas for primary adjustments. So then we need to check what is the amount of primary adjustment made during the previous year, and we need to check the computation of excess money or part thereof arrived based on the difference between the LP and the primary adjustment, and which the internal taxation has actually been undertaken. So this is one of the next steps. And third one is whether it has been received within the prescribed time limit to India. That is more important, because under FEMA, once the export has been done at a lesser value and the amount has been quantified as a primary adjustment, it has been brought back to India. If not, we need to charge interest on the imputed difference. So whenever there is a doubt, it's better to seek an opinion from the expert who is specializing in transfer pricing adjustment, because if the auditor is not practicing international taxation, it is a cumbersome process. Domestic taxation, normally we are comfortable, we are used to that. But international taxation, it has requires a lot of other details and supporting software, tools, etc. If we require any support, we need to engage somebody. Normally, the company will engage. If it is small practitioners or small assessees, then it will be better to get an opinion from another expert who is familiar with these details. And then next one is assessee has incurred any expenditure by way of interest exceeding 1 crore. If it is interest paid to a foreign party less than 1 crore, there is no issue. Further, please note that this is only with the related party. If you have borrowed anything from the bank, then there is no issue. But in this case, if it is a related party, then we need to be extra cautious under 94B. Then we need to what is the amount of expenditure incurred by interest or similar nature. Then earnings before interest, tax depreciation, amortization, EBITDA during the previous year. So this is the basis. If the interest is more than 30%, then that amount will be disallowed. But that will be carried forward to 8 years, because subsequent years, suppose the interest paid is less than 30%, then this amount can be claimed. And we need to quantify what is the amount brought forward and what is the amount brought forward. As I said, it is eligible to be carried forward 8 years. So this is only applicable to interest element wherever it exceeds 30% of EBITDA. Whenever the company makes any payment of interest to a foreign party, then ensure that the workings of EBITDA is available and the interest is less than 30% of the EBITDA. And the third one is 30C, whether the assessee has entered into impermissible avoidance arrangement, as referred to in section 96 during the previous year. Yes, no. What is impermissible avoidance agreement? Just to avoid tax, I am entering into some arrangements because I know that tax rate in India is 30%. If I park certain things in Singapore or some other country, the rate of tax will be nil or at lower rate. So to do that, I am entering into some transactions to reduce this tax liability in India. Then the impermissible avoidance agreement. Then we need to mention all the parties, what is the amount of tax benefit in the previous year arising out of these things, so that the department will evaluate whether there's any evasion of tax in Indian jurisdiction. Actually, it talks about the primary test and as well as additional test. The main purpose is just to avoid the tax, that is to obtain tax benefit. But we must satisfy one or more of 4 tests, additional tests under 90. Then only it will be treated as impermissible avoidance arrangement. The additional tests are arrangements create rights or obligations which are not orderly created between person dealing with arm's length. Suppose if you do the transaction with other unrelated party also the same basis, there is no issue. Arrangements results directly and indirectly in misuse or abuse of provision of the act. So misuse test, just to avoid certain things, I am entering into certain transactions. Arrangements lack commercial substance or deemed to lack of commercial substance. So this is nothing but only it is not a commercial substance. For example, the item valuing 1 crore is sold at 50 lakh. It's not commercial substance. Nobody will sell at a lower rate to an outside party. So those things. Arrangements entered into or is carried out by means in a manner which not orderly employed for bona fide purposes. So it is not a normal business transaction of the entity. Only for this purpose, they are entering into transaction. This will be treated as abnormal manner test. So if any of this additional tests are clicked, then along with the primary thing, this will be treated as a impermissible transaction. If none of these additional tests is fulfilled, then there is no issue. So the transaction will not be classified under this clause. So now come to 31A. This is one of the painful areas for the tax auditors. We are always challenging. Loans and deposits. See, those who are into practice for a longer period, they know there used to be only 2 clauses earlier. Simple loans accepted, loans repaid. We used to give the details. But considering the changes in the business practice and the way the entities are getting loans or paying loans or availing benefits, they are keep on adding various clauses under this tax report. The first item is there is no make change. This is regarding the details of loans or deposits, amount exceeding section 216 SS. 216 SS talks about anything more than 20,000 rupees. So we need to give the name, address, and permanent account number or Aadhaar number if available with the assessee of the lender or depositor. So obviously we need to give the name and address of the party, because without the name and address nobody will collect money. So obviously that is on the basis of KOC. So assessee will have the details of name and address. But in some cases there may not be any permanent account number, because the amount of deposits loan is only 50,000 rupees. The person who has lent the money may not be a assessee. So there may not be a permanent account number. So in the case we say that not available. But if it's available, we need to mention that. The second thing is amount of each loan or deposit taken or accepted and the code or nature of such amount as you note one. So we need to give the details of the nature. Now they given a code. I will come to that in a subsequent slide. We need to mention that code, whether by accounting mistake or draft or transfer, whatever may be. Whether the loan or deposit was squared up during the year. Suppose I have taken a loan of 1 lakh and I settled the loan of 1 lakh during the year itself, or I adjusted the loan of 1 lakh. So those details also to be mentioned. maximum amount outstanding. Suppose opening balance is 10,000 rupees. I have taken a loan of 50,000 rupees and paid 20,000 rupees. So my closing balance is 40,000, but my maximum balance is 60,000 rupees. We need to mention that. Whether the loan or deposit was taken or accepted by check or bank track or use of electronic clearing system through a bank account. This is one of the most important thing. If it is done other than these methods of receipt, then the entire amount will be taxable. So we need to have the proof that this amount has been realized only through this mode of acceptance. So if in case of the loan or deposit taken by check or draft, whether the same by way of account pay check or account pay draft. So not bearer check is not permitted or bearer draft is not permitted. It must be account pay check or draft. But in that case, there is a challenge to the auditor because obviously the check would have been present to the banker. Auditor will not have a preview. Most of the bankers will not give the check leaf. Previously, they used to give the check leaf to the client and they will furnish to the auditors to check whether the instrument was crossed or not. But nowadays, it is practically impossible considering the number of transactions. So we need to give a disclaimer in our tax audit report saying that this is basis the details available with the client. But one clue is normally if it is account payee, it will go as a clearing. If it is a balance check, they will mention the party name. So from that we can get the details. Otherwise, it's better to give a note that we have relied on the details available in the books of accounts. However, these details not be given in case of a government company, banking company, or corporation established under central, state, or provincial act. So these disclosures not required in these cases. For all other associates, we need to give these details. So there are certain observations under this loan transaction by QRB. In some cases, they have not even mentioned the name of the person from whom the loans are taken. They just mentioned various parties. It is not permitted. We need to give party-based breakup. For example, the company is taking a deposit from 100 dealers. We need to give the details of all 100 people. And we can't say that secondary deposit 10 crores within bracket 100 people. That is not permitted. We need to give the details of all people. And further that in the format, they mentioned me or us. We need to be, if it is a sole proprietor, we need to mention as me. If it is a partnership firm, we need to be us. So the English language has taken some of the auditors to task because they have not updated the mind. That is a command of the QRB. Please edit the format of the 3CB and 3CA or 3CD as applicable to fit the status of your entity. 31B is a new that is regarding each specific sum, and the previous 31A is regarding any loan or deposit. This is regarding specific sum, applicable only for immovable property. So all the requirements are same. Whenever the company or associate gets any money into the system for transfer of any immovable property, either as advance or sale proceeds, whatever may be, then we need to mention the details of those transaction, name, address, account number, amount of each loan or deposits or whatever may be, whether it is by account pay check or that, those details. Similarly, this is not applicable for government company or banking company or corporation established under Central, State, or Provincial Act. So what is this purpose? Any amount received for sale of property in the current year, as you know, the immovable property can be sold only by a account pay check or draft or account transfer if the company accepts cash and stocks this amount in the balance sheet item, and subsequent year they are making the transaction. At the time they are offering for capital gains, this goes on notice. So the auditor need to comment on this, whether the amount has been received by check or draft or account transfer. DA is regarding the amount each receipt in amount exceeding the limit specified under section 269 ST. It is regarding the business transaction. First two items regarding balance sheet item. This is regarding P&L item. Say any aggregate from a person in a day, or in respect of a single transaction, or in respect of transaction related to one event or occasion from a person. So you have to see it is aggregate from a person in a day, or in respect of single transaction. For example, I am getting this, raising an invoice of 1 lakh, but collecting that amount in 10 tranches of 10,000 the same day, or I am raising invoice from a person, but accounting in different transaction, or relating to one event or occasion from a person during the previous year, where such receipt or otherwise then we check or draft. So once it crosses, we need to give the details. Same thing name, address, and permanent account number, nature of transaction, amount of receipt, date of receipt. So similarly, each receipt index of 269 ST in aggregate from a person, same thing we need to comment whether the name, address, of a person, amount of receipt. This is also for the purpose of tracking any cash receipts. Now come to payments. Each payment made in excess of a limit present 269 ST. Then we need to comment whether a single transaction or event or occasion, whatever may be. We have to mention the name of the party, nature of transaction, amount, date of payment. So for both receipts as well as payment, we need to give the details. This is a reverse of the thing. But here for BA, BB, and BC, BD, etc., in addition to the government company, bank company, or post office savings account, cooperative bank, or in the case of transactions, or case may be, those are all exempted. This is regarding repayment of loan. So 269 talks about receipt of loan. Now 269T talks about repayment of loan. So we are available the loan in the preceding year or in the current year, and we are making a payment in the current year. Then we need to mention if it is made in excess of 20,000 rupees, then we need to mention the details as required as this class. So name of the person, amount of each payment of loan or deposit, maximum amount outstanding, whether the amount the repayment was made with check or draft. If it is check or draft, whether it's account payee. Please ensure that under 269 there was a clause that whether it's acquired up during the year. You would have mentioned yes, but in that case, definitely those details have to be reflected here because the settlement, obviously, they'll cross check whether we have given the details here in this class. Otherwise, it will be treated as a mistake. So, in cases, this is regarding QRB observations. Repayment of time deposits, such as fixed deposits or term loans, including annual report, were not reported in the tax audit report. This is one of the clerical mistake or clean mistake, because once you classify certain things as a loan in the financial statement, obviously those details has to be reported under this clause under CCD. So we need to be extra cautious. Whatever already classified as loan in the balance sheet to be disposed of. Not only those classified as loans in the balance sheet to be disposed, we need to evaluate all the credit items in the balance sheet to check whether any loan items has been blocked in some other head in the financial statements. If so, we need to comment. Here also, we need to ensure about the wordings in the report. Me as etc. It is only a normal general comment. This is regarding 31D. Any amount or loan or deposit or specified amount advance, an amount exceeding the limit within 269T. Receipt otherwise, then we account to be check or draft. That is, we need to give the details. So we need to mention the name of the party, amount of repayment of loan or deposit, or any specified advance received. Otherwise, then we check. So we need to give the details. It's only for tracking purposes. Similarly, if it is not through account pay, we need to stay. Here also, it is not applicable for government company, government, banking company, etc. As I told you previously, it was only two clauses, 269 and 269T. Now they added so many clauses to ensure that to cover all the items required for the income tax. This is a note I referred. So we need to be careful while giving the code number, because based on the code, it will be tracked and brought to the taxation. If it is a cash payment, you have to mention A. Cash receipt is B. Obviously, it will be directly taken to the memo. Payment through non-account pay checks C and D. It is also dangerous. Transfer of assets. It can happen because adjustments can happen through a transfer of asset or transfer of liability. So in that case, we have to mention E or F. Conversion of assets G. Conversion of liabilities H. Journal entry. Certain things are debit one party, credit another party. Those things also we need to disclose IJ and any other mode. KL. It is nothing but your online transfer or bank transfer, then we have to mention KRL. 32A, this is also one of the most challenging process for the tax auditors. If the company is not making any loss, there is no issue. We will simply put not applicable. If the company has the history of losses, or if the company has any litigations with the department, then it puts a challenge to the tax auditor. In case of brought forward losses or depreciation allowance, we need to give the details of serial number, assessment year, nature of loss or allowance, amount as returned, the assessed depreciation is less and no appeal pending, then take assessed. All losses or losses not allowed under the section 115 BA, BAC, BAD, BAE. Amount as adjusted at the trial of additional depreciation, amount as assessed. Give a reference to assessment order. So it's simple, but practically it is more challenging. For example, if the company has lost, filed a loss return, the assessment officer has made some additions or made it as taxable income. Then subsequent year, the assessee would have filed an appeal. The appeal may be pending at different forum. The appeal would have been allowed and remanded to the assessing officer. There can be so many permutation combinations. But here we need to mention the fact clearly. For example, if the particular year there is a carried proper losses, we need to mention the fact. And if the matter is sub judice, then we have to mention that fact that it is though the returned loss dispatch over the assessing officer made a disallowance or reduced the loss or made it nil against the assessee has gone on appeal. Accordingly, we can quantify that, so it will be on record instead of getting overlooked. In subsequent year, when the appeal is allowed in favor of assessee, obviously the original loss will be restated. If it is allowed or decided against assessee, then the loss determined officer will come into picture. But till such time, those details to be mentioned clearly. That is one of the most important thing. And second thing is, whenever there is a merger or demerger, here also there is a challenge whether that is eligible for the company to or entity to consider the losses of other entity. In that case, we need to see the orders of the appropriate authority. There is a request for a break for 5-10 minutes. I am not sure whether it's possible. I request the CRC to confirm whether we need to take a break. But I am fine with continuing that because now I'm in class 32. If it's a bio break, I can, after this class, I'll take a break for 50 minutes so that and continue. But before that, I'll complete this class first. So whenever there is a merger or demerger, then we need to factor whether those losses to be considered here. If so, we have to check the assessment order of those entities and also the order of the appellate tribunal or the court, whether that losses can be considered in this case of the assessee. In case of demerger, certain portion of the loss to be moved out of this entity. Those things to be factored and appropriately given. And wherever there is a dispute, we need to keep a track because otherwise we'll be held responsible. We just simply copy paste the loss as the return. We need to verify the assessment order. And if the order is not received, we have to get a declaration of the assessee that they have not received any order. That fact to be mentioned in the tax audit report. Even suppose assessee has received the order, it is not shown to us also, we can't be held responsible. So we can take care of ourselves by documenting those facts in the tax audit report. And the next is regarding change in shareholding, 32B. As you are aware, for closed companies, the losses can be carried over only if the beneficial owner of more than 51% remains same in the year of loss and year of availing the adjustment. So if there is a change in shareholding, obviously the loss will be permitted to be carried forward. But most of the cases, the mistake happens because we will not compare with the previous shareholding. If the assessee is a continuing assessee, we will know something, we will keep track. But otherwise, it is always better to, if only particularly in case of private companies, get the list of shareholders as on the date for each assessment year and store in the file, so that whenever you are going to adjust those losses in the return of income, then we can cross check whether they are eligible for loss or not. It will have impact on your deferred tax also, because if you have quoted deferred tax for the brought forward losses, subsequently there is a change in shareholding. If you are not entitled, then we have to remove those deferred tax impact from your financial statement. It will have impact in your P&L also. So obviously we need to keep track of that. So now it's 4:10. Can I have a break for 2 minutes? I have no problem. Or if you want, I can continue.
Sir, here is sir.
Huh?
Members cannot able to unmute themselves.
No, one member has mentioned that in 5 to 10 minutes, but if you
is
require,
also-
I can give, otherwise I can continue. There is no issue. Okay, I'll continue then. Yeah, thank you. The screen is visible, no?
Yes, sir, visible, sir, visible.
Yeah, thank you. The next clause is 32C. Also see, whenever there is a speculation loss or speculation business, as reported in section 73, then we need to give the details of those losses, because speculation loss is not permitted to be adjusted against other income. It has to be
ரொம்ப
adjusted only against
ஃபாஸ்டா
speculation
பேசுறீங்க
gain.
சார்.
Pardon?
ரொம்ப ஃபாஸ்டா பேசுறீங்க சார். கொஞ்சம் மெதுவா பேசினாலே சந்தோஷமா இருக்கும் சார்.
Sure,
Please,
sure.
sir.
Kandipa, sir. Thank you. So this is regarding section 73, that is speculation loss. As you are aware, the speculation loss can be adjusted only against speculation gain, not against any business gain. So wherever there is a speculation loss, we need to quantify those items and mention this is loss. And so that in the subsequent year, whenever there is a gain, it can be adjusted. Please note that the speculation, same type of speculation need not be there. It can be any speculation gain in the subsequent year that can be adjusted. And similarly, whenever there is a loss incurred under section 73A in terms of specific business, in the previous year, we need to give the breakup so that it will be easy for the department to track. And similarly, clause 32E is a new one where there is deemed to be carrying on speculation business as referred to in section 73. We need to give the details of the same. The first clause 32C is only if it is lost, but 32E talks about if the company or associate doing any speculation business, then we need to give the details, because it will help the assessing officer to review whether any loss has been hidden in any other income, so that they will review thoroughly and do the necessary adjustments required. So as an auditor, we need to have the details of the profit or losses or depreciation allowance. So if we are the auditor for the first year, then we need to rely on the previous year tax audit report, and we need to check and get the copy of all the returns filed in the previous years wherever there was a loss, and that reported in the previous tax audit report. And we need to review all the assessment orders or any communication from the department to check the correctness of the amount disclosed in the last year tax audit report. And we need to review not only the original, revised or updated returns. Now with the electronic portal, in the recent years, we can see what are the amendments or orders passed. But for the older years, we need to see only the physical file. So it's a cumbersome process. But we have no other options. We need to check, and we need to get a written representation from the assessee that the details given therein are correct. And wherever there is an appellate order, we need to see whether the appellate order has been given effect to. For example, appellate order is remanded to the assessing officer, then the demand is not quashed or loss is not nullified or corrected. The officer has to look into and give us a revised order till then the original order stands, unless it is cancelled. Losses cannot be set off or carried forward. We need to have the details of gambling, betting, card games, etc. Or similarly, losses from exempt income. For example, share of loss of broadband firm. There is no adjustment because income is exempt. Obviously, the loss is also not permitted to be deducted. And as I told you earlier, a change in shareholding more than 51% with voting power, obviously the losses will not be permitted to be carried forward. And so the speculation loss, we need to be extra cautious and we need to have all the details available in our file. And similarly, QRB, the only one observation I could see, they have not mentioned the date of order, just mentioned as per the order passed. That is not correct because for the department to review the correctness of the amount mentioned in the tax audit report, we must rely on some documents. Obviously, you have verified the assessment order or the retribution order of the department. We need to mention the fact with the date of order. It will be easy for them because subsequently, if there is any other order, it will be easy for them to update or correlate. So we should not just mention as per the assessment order. We have to mention the date of the assessment order and which section it is, 141 or 143 or 144, as the case may be. So this clause 33 is regarding our claims available under section chapter 6A or chapter 3, that is 10A, 10A, etc. We need to give the details of section under which the direction is claimed. See, now we are coming into the computation statement. Now we are talking about from the balance sheet, because computation is the responsibility of the assessee, not on the auditor. But once you are going to quantify the amount of direction under section 6A or chapter 3, we need to verify the correctness of the computation. So it puts a challenge on auditors, because if there is any wrong claim or wrong addition, the quantum of direction claim under section chapter 3 or chapter 6A will go wrong. So we need to have a proper working on basis which we quantify the amount that need to be documented properly. It will put challenge if the company or associate have multiple businesses and subject to different things. Then they will consolidate all those things and file a single return. But then only they will know the amount of direction are available in section chapter 6A or chapter 3. So it will put us to difficulty. So we need to verify admissible under section fulfill the conditions, because each clause has certain conditions to be complied with. We need to check everything has been complied with. So we need to report section wise amount based on the audited books. So we need to not a global figure under chapter 6 or a global figure under chapter 3. We need to mention what is the direction under ATC or AT JJA or ATHST, AGCG, etc. We need to go section wise. Similarly, wherever there is a multiple units, as I told you, it will put some challenge to the auditors, but we have to have proper documentation and summarize those numbers and mention those things in the tax audit report. And similarly, you please note that certain directions is available only if the return is filed within due date. If the return is not filed within due date, then obviously the direction is not available. Then we have to mention the fact and we have to put nil not or not available. And the same clause is applicable for losses also. Suppose for the preceding assessment year, the loss, the return was a loss return, but filed after the due date. Obviously, the loss will not be entitled for carry forward. So in the case, we have to put a dash and saying that the company, though had a loss return, considering it's filed belatedly, not entitled for carry forward. We have to be cautious. 34A. This is one of the clause which takes substantial time from the auditor's perspective, because we need to do the thorough reconciliation of the TDS. Almost all payments by the SSC is subject to TDS nowadays. So we need to give the details of TDS TAN number of the entity, section under which tax is directed, nature of payment, then amount of payment or receipt, the nature specified in clause 3, and total amount on which tax is required to be directed. And the next one is total amount on which tax was directed or directed. The first is what is amount to be directed, and the second is on which how much is directed, and amount of tax directed or directed. For example, 1 lakh is the amount on which tax to be directed. Assessee has directed tax on 80,000 rupees. Then on 80,000, 10% is 8,000. So this is the way we have to give the details. Total amount on which tax was directed or corrected at less than specified rate. For example, the specified rate is 10%, but the assessee has directed 2% basis on order or lower reduction certificate. Then we have to mention the tax. Amount of tax directed or corrected on 8, that is on the item. Then amount of tax directed or corrected not deposited to the credit of central government. And so then we have to mention the details. I have corrected or not remitted. Then that is the serious violation, because non-deduction is one violation, but after correcting, if you are not depositing, that will be treated seriously, leading to penalty and prosecution. So we need to have a thorough reconciliation, not only of your P&L items, you need to have the details of balance sheet item, because any capital acquisition, purchase, etc., any payment to contractors, capitalizing the books will be subject to tax. So obviously, we need to have a thorough details of your payments, not only for profit and loss perspective, also from balance sheet perspective, to ensure the company complies or assessee complies with the TDS requirements. And wherever there is a requirement to furnish a tax return, that is TDS return, then we need to give the details of TAN number, type of form, because whether it's only salary income or a contract income or what rental, whatever may be, what is the type of form to be filed, what is the due date for furnishing, what is the date of furnishing. So if due date is 15th of May, if it is filed within 13, no issue. If it is filed after that, you have to mention the fact. And we do mention that it contains all the information as required into the form. If not, we need to give the details. So we need to thoroughly review the TDS return to check whether it is complete in all respects. Then accordingly, we have to make a comment in our tax audit report. Wherever there is a delay in payment of tax or delay in payment of filing of return, then obviously assettees need to pay interest. So in that case, we need to mention the fact that what is the TAN number, what is the amount of interest payable, and the amount of interest paid. So this is just a statistical purpose, so that it will help the officer to. I'm getting a message that the voice is not clear. Is it so? Is my voice clear?
Sir, yes, sir, it's clear. Sometimes only little bit blur.
Okay.
You can continue.
So
Sir.
in that case, we need to mention the fact that we need to mention what is the amount of interest payable and of the amount payable, what is the amount paid. So those details will be given in the tax audit report. So the next clause is 35A and B. This regarding quantitative details. It's applicable for both for trading company as well as manufacturing company. For trading company, we need to give the details of opening stock, purchases, sales, closing stock, shortage or excesses. So this is only for trading quantity particulars of principal items. We need not give for all the items handled by them. We need to select what are the principal items. For those, we need to mention this. Please correlate this information with your financial statement, because in most of the cases, the numbers disclosed in the financial statement differs with the numbers as disclosed in the tax audit report. If the number of line items is voluminous, we can select the top 10 items and give those details in the tax audit report. And we need to give appropriate note saying that we have considered these are the items based on certain judgment. But we can't evade giving the information in the tax audit report because it will be treated as a non-compliant. But we need not give for all line items. We need to give for the specific line item or principal line item. In case of manufacturing companies, in addition to that, we need to give for raw materials, what is the opening stock, what is the purchases of the total stock, what is the amount quantity consumed of the production, what is the sales, what is the closing stock yield, because what is the amount given for the consumption, and what is the return as a finished goods, the yield percentage. So this will help the department to evaluate whether it's any huge variation compared to the previous year or industry practice. And we need to give the details for finished goods, work in progress, and byproducts. So this information to be given. Some companies may have both manufacturing and trading. In that case, we need to give all the information, but have proper working paper available with you, duly certified by the company, and ensure that this information given in this statement is tallying with your inventory clause, what we commented earlier. So it is complete in all respect, so that there will not be any additions or any dispute at a later date. PRB has reviewed this clause. For example, the company has not quantity details of principal items of traded goods were not reported, though they are showing trading purchases and sales in the financial statements. So if there is any sale, you have to mention at least a few principal items. If there is a purchase of stock in trade and sale of stock in trade, obviously there will be a trading business. We need to mention the details in the tax audit. And similarly, some cases the closing of goods acquired for trading was reported as nil. The quantity details showing the value, that is not correct, because we need to correlate these two things. That's what I said. We need to ensure that the financial statements is agreeing with your tax audit report in all respect. Similarly, in some cases, associates engaged in manufacturing, the percentage of yield, shortage of excess were not reported. That is not fair, because we manufacturing company will have the details of amount of material transferred to the floor for production. So, for example, they have transferred 10 lakh kgs of iron to the floor for production. Of the 10 lakhs, the finished good is only 9 lakhs, because the balance 1 lakh may be the scrap items. So 9 lakhs is 90% of the yield. We need to mention the fact. And similarly, that 1 lakh has to be reported as a shortage or excess, or we have to say scrap sales. Certain cases, the 1 lakh may not be the scrap. It may be a value reduction, quantity reduction on account of various parameters, because once you do the process, the weight increases or decreases, depends on the type of the industry. Accordingly, we have to mention the fact, so that the percentage of yield is more critical to ascertain whether the information given in the financial sense is accurate. Similarly, some of the cases, the finished goods, that is stock in trade, is shown as raw material, because raw material is nothing but is intermediate item purchased and used for production and subsequently sold as a finished goods. If you are purchasing a stock in trade and selling is as such, then it can't be classified as raw material. So definitely it will be treated as a non-compliant. Now come to clause 36A. Whether the assessee has received any amount in the nature of dividend as referred in subclause C of clause 22 or section 222E is one of the most dangerous sections. It is applicable mainly in the case of closely held company. Any payment to a party having any substantial interest, and as per the section is more than 20%. In the case, the payment of loan or advance will be treated as dividend, deemed dividend. So we need to be extra cautious, because we can't evade this. But not only this, if you are talking about the provision for taxation, Now this is brought in the purview of dividend. So obviously, we need to see the current year tax liability is inclusive of this deemed payment. All payments made to related parties, we need to thoroughly evaluate whether any of the amounts will be subject to tax under 222E. If so, we need to give the details. This is regarding receipt purposes. I'm talking about the payment purposes, but whenever we receive some loan from a related party, as auditor, we need to see whether it is treated as dividend. Because other party would have treated as dividend, you can check with Form 26AS or Form AAS. If not, even if it is not reported, we have to get the details of all receipts from the related party by way of loan to check and confirm whether it will be treated as a dividend. If so, we need to report here. If not, we need to have proper documentation why that amount has not been treated as dividend and what reasoning, those need to be documented. This is also for buyback of shares, mainly to track the shares bought back. Otherwise, this goes unnoticed. So now the department wants auditor to certify any amount received as a buyback of shares. So, for example, the company has some investments and officially they have bought back some amount and received some amount. In that case, we need to give the details with the cost of acquisition and shares bought back. This will be subject to tax. Clause 37, 38, and 39 regarding audit under cost audit, central audit, finance audit. 37 talks about cost audit. We need to check whether any cost audit was carried out. We need to inquire the assessee whether first of all the cost audit is applicable to the entity. If so, we need to ask whether any audit was performed during the year. If yes, we need to get the details to see whether there is any qualification or disqualification or disagreement by the cost auditor for any other item, because it's more relevant because cost audit is mainly for arriving at the cost of the product of the company. Obviously, they'll be quantifying the closing stock value also. So we need to see whether the value as determined by the cost auditor is in line with the value as certified by us or the auditor in the financial statements. If not, we need to ascertain the reason for disagreement. We need to have proper reconciliation, and we need to report the fact in the tax audit report under clause 37. So this most important thing, we can't just say carried out yes without any details. You have to give all the particulars, whether it has been done. If so, whether we have reviewed the tax cost audit report and all those aspects have been factored. If suppose assessee informs us that the cost audit was not carried out till such time we complete our tax audit report, then we have to mention the fact. So the cost audit is applicable to the company or assessee. The report was not produced to us for verification. Accordingly, we are not commenting on the same. This is the must. Don't evade this. Clause 38 regarding centralized act. If at all there is any order, then we need to audit. We need to get the details. And similarly, as in the case of cost audit, we have to give the details. Clause 39 regarding 72A of the Finance Act. Now this section is no more in existence, and accordingly is not applicable because GST has taken over, and I don't think it has any relevance. If at all there is any past demands or anything, then we have to properly report in the respective clauses in our tax audit report. As regards these clauses, the QRB has observed that representation from management has been relayed without looking into the report. That is not correct. Representation management is to ensure whether they have conducted the audit or not. But the auditor need to get a copy of the report and review to check the qualification or disqualification, what it may be, and accordingly report under relevant clauses under in the Form 3CD. We can't just rely on the management representation. In certain cases, the cost they mentioned that the cost audit report is attached. However, there is while there was no clause, no was reported. See this contradiction. In the tax audit report, we will mention that we are attaching cost audit report while uploading the 3CD. But in the relevant clause, the clause is mentioned as not, no, or not applicable. That is a contradictory statement. We need to be careful because it normally happens when we are copying the data from the previous year. That should be similarly in the case of other one, Excel also. We need to see if we are attaching any document, then we need to ensure that relevant disclosures have been given in the respective clauses. Clause 40 talks about we need to give the turnover of the assessee. One mistake normally comes is the sale of scrap. Though for the accounts purposes, we'll give the principal items and other items. We'll classify as sale of manufactured items, trading items, what may be. Companies will follow the requirements of Schedule 3. But for this purpose, we need to give the total turnover of the C includes scrap sales. We need to see the gross profit. What are the items considered for gross profit? As I told you in the earlier clauses, the component of cost, it to be consistent. We need to have a same parameter for the current year as well as the previous year, because we need to give the these details not only for the current year, we have to give the details for the previous year also. If you are going to do any regrouping in the current year, please ensure that the same regrouping is done the previous year also and have the appropriate working and attach the same as part of your tax audit report. So as to enable the officer to review and check the correctness of the same. Net profit ratio, there is no issue because it is simple directly from your P&L, but gross profit is arrived figure because that is not directly available in your financial statement. So we need to evaluate those things and basis the workings and ensure that that is consistent as compared to the previous year. Stock in trade or turnover, there is no challenge because we will be comparing the number as per the financial statements with the turnover as in the first class. So obviously there will not be any issue. Material consumed / finished good produce is nothing but the percentage or yield the percentage. So obviously we have the details in the preceding CARA quantity details. We were given only for the principal items, but here we need to give for the total items what is the material consumed in value and what is the value amount of finished good produced, so that it will be easy for us to check the comparison. So as QAB on this ratio percentage, it was observed that the respect of service sector not applicable should be reported under the clause instead of leaving the same blank. For example, gross profit is not applicable for a service sector. We can't just leave that item as blank. We have to say it is not applicable. In certain cases, scrap sale was not considered while arriving at the figure of turnover. We need to mention that clearly and have the working paper properly available. The net profit after tax was reported under circular, not permitted because always net profit means profit before tax. So the ratios to be compared before tax and net profit and with the turnover. So there was a mistake taking the after tax profit. In some cases, the calculation of stock in trade to turnover ratio, average stock was taken. That is not permitted because the guidance specifically provides what is the basis of the stock to be considered for working out the ratio. We need to have the working for that and give the correct number as a disclosure. We can't average out the stock as it will mislead the assessing officer. In certain cases, the amount of material consumed reported on the cost is not and loose materials. Because the material component, whatever material is forming part of finished goods has to be included. We can't be pick and see. We need to include all the items. The percentage is proper. And the reporting of saturation of the reports, that is not correct to give all the details. If it is not applicable, please mention it is not applicable, but don't leave it blank. And similarly, mismatching the numbers and figures, material consumed reported in the preceding previous years. So that should not be avoided. Wherever there is a variance, review it again to check whether the variance is proper and due to certain proper reasoning instead of just leaving it unanswered. Clause 41 is regarding the demands raised or refund issued during the previous year under any tax laws other than Income Tax Act, because Income Tax and Wealth Tax Act the department knows, but they want the details for other statutes. So obviously we need to review all the other statutes applicable to the company to check whether there is any refund. For example, GST, if the assessment is completed and there is a refund determined, properly similar statute or demand or either law, you have to see if there is any demand or only for the previous year. The transactions or order past the year is not relevant. Similarly, the order prior to the year beginning is also not relevant. We need only for the current.
So voice is not clear.
Information, so we need to furnish. Hello.
Sir, your voice is not clear.
I think some network issue, I think then.
Okay. Now you can continue.
I'll repeat. So in this case, so in this case, we need to have the proper review of all the orders other than Income Tax and Wealth Tax Act and check whether any demand or refund issued or raised during the previous year, in which case we need to give the details in the tax audit report under relevant clause. And the next one is clause 42. This is regarding the furnishing of statement sections, form 61, 61A or 61B. See, obviously, we are giving various forms, post physical transactions, etc. We need to see whether the assessee is obligated to fill form 61, 61 or C. We need to say yes or no. If no, there is no issue. If yes, we need to mention the department or entity identification number, type of form to be filed, what due date of furnishing, what is the date of furnishing, whether that in form contains all the details required. If not, furnish the details which are not reported. So we need to verify the completeness of the form filed. Form 116, the point by the department. If not, we need to mention those details that are not reported. This is a factual statement, so it is easy for us to review and do the information. As I told you, regarding transactions, so we need to set that to the C. So we need to the information are properly disclosed by the assessee form filed. If not properly given, ask them to fill a revised form, and you can give the proper continuous report. Omissions, discrepancies, or non-compliances, etc., to be highlighted in the report. Also, we need to ensure that the proper TDS or TCS have been disclosed in the tax audit report. The purpose is to give a accurate information for all transactions, proper cross verification tax authorities. If the form C is completed, the department to correlate with other party, so we put difficulty on them. If they found out any mistake in the form filed, then obviously they will revert back to the auditors. So accordingly, we need to be extra cautious. The form is filed with the assessee. So the clause 43 is regarding group. Whenever there is a foreign subsidiary or foreign holding company, whatever may be, assessees or its parent entity or alternate reporting entity is liable to furnish report as reported in section 286 subclass 2. Yes or no? If it is yes, then we have to give the details regarding whether the report has been furnished with assessee or its parent entity or an alternate reporting entity. So we need to check whether they have given the report. What is the name of the foreign entity? What is the name of the alternate reporting entity if applicable? And what is the date of furnishing the report? So this is only, it is also connected with transfer pricing. So we need to check with your transferring colleague or your consultant to get appropriate details to ensure compliance. As I told you, TDS was one of the cumbersome area for the auditors. This is latest one. We are taking substantial time in collating details. Where if the company has a robust accounting software system, there is no issue. They can generate reports. In other cases, it is difficult. If they don't account the information properly while feeding the information in the accounting records, example in Tally or SAP, or maybe getting the details will be difficult. So educate the client to do the reconciliation on a monthly basis, so that the information provided under this clause is proper and correct. Under this clause, we need to give the total amount of expenditure incurred during the year. It is not only for from revenue perspective, it is also from capital perspective. Expenditure in respect of entities registered under GST, then related to goods or services exempt from GST, then related to entities falling under the compost scheme, relating to entities, total payment of registered entities, expenditure relating to entities not GST. So we have to first arrive at the total payments, either both together. Then of which what is covered under GST, what is not covered under GST. Covered under GST, we have to bifurcate into various components and give the details. For this purpose, we need to have a proper working paper. So what is the total value of the expenditure in P&L for the year? That is first item to start with. And we have to add the value of capital expenditure not included in P&L for the year. For example, you have made certain capital payments which are subject to GST. Those details we need to add. And total value of non-cash charges considered as expenditure. So certain things may not be subject to GST. So we can deduct that. Less total expenditure excluded for being transactions in money. So that is not liable for GST. Less total value of expenditure excluded Schedule 3 to Central GST. So that also to be removed, and balance value of the class 44. So this at 44 to be taken to the previous slide, and we have to give the details as required under this clause. So this reconciliation is a must. Unless they do the reconciliation on a monthly basis, it will be difficult for the company or assessee to collate and give to you for verification. As an auditor, it will be practically impossible for us to 100% verification. We'll be doing only a random verification on a sample basis. So accordingly, if the details are thoroughly readily available with SSC, we can do a sample check. Those information to be given in our tax report also, that we have done a sample check and nothing wrong has come to our attention. If the details not available, it will be difficult for us. Then we need to have a qualified report. So it may be noted that any expenditure that is incurred only and exclusively for business or profession of the SSC qualify for reduction under the Act. Registration otherwise of the payee under the GST Act has no relevance. So we need to take the total payment that is irrespective of the GST or not. That is totally different. But from this perspective, we need to have the details of the total expenditure. To conclude the class 44, any questions you can put in the chat box. I'll be happy to sir. Received one list from the chairperson. I'll look into those questions first. I'll answer that. Then I'll come back to the chat box questions. In the interim, you can type in the chat box, or you can raise your hand and.
Members, you can unmute yourself and ask your questions.
One question I see is whether the tax audit report can be revised. If so, to what extent? If so, whether separate UDIN is required for revised report. Yes, tax audit report can be revised because after filing your tax audit report, you come to know that information file. Subsequently, you come to know that there are some changes in the numbers disclosed. For example, chapter 60 or whatever be, because of filing the tax audit report now, and subsequently there is some changes, or information received by you as undergone change, because filing the tax report based on the provisional numbers, audit is not over. Accordingly, you are giving based on certain provisional number to ensure that there is no deviation under the timelines. Subsequently, this is the final numbers you are completing the tax audit, then you can revise the report. Obviously, the UDIN for the revised report also. The old UDIN is no more valid. You have to take a UDIN for the new report. One query is any instance of addiction under section 143A. Yes, there can be changes where there is the tax, that is the supply is not paid on time. In the case of put the eligible function, that for any additions under 143A, but the remote charges. Capital assets converted into stock in trade. Suppose an ancestral urban agricultural land in Chennai held an SSC involved. Whether plotting of land itself is a business activity. So no, it is assessee. Whether assessee in business, whether the land is in the books of account or not is a different. First thing you have to see. If the assessee is not doing any business, merely if I'm suppose I am an individual, I'm into salaried employment. I have received some ancestral property on account of family settlement. That is my removed property. If I decide to sell it, that is not subject to tax. Obviously, this question does not arise. Obviously, that amount to be offered for taxation under capital gains. Conversion for 42. What is the date of conversion is more important. Accordingly, we need to evaluate the fair market value basis the gate-in value or valuation report. That is the basis for passing the book entry. And any subsequent gain will be offered for taxation under business income. Whether the gate-in value given in the department is for developed land or undeveloped land, it is a question I can't answer over here, because normally the gate-in value is for the developed plot. Cost of acquisition, whether professional valuation report for value land and building as on 1421 is evident. But normally the date of acquisition they are asking. See, we need to give the exact date of acquisition and the exact cost. If the cost is the property acquired very old and you don't have the details, you can mention the fact and give the details. This is the valuation report. There is no harm in that. How to obtain information regarding escalation claim accepted? See, obviously, we'll be checking the communication from the parties. Whenever there is a claim, obviously, as an auditor, we'll be checking the details. If there is a legal dispute, we'll be checking the papers filed with the court or orders of the court or arbitrator. So those are the papers. Only MRL is not going to help us. MRL is going to help us in say that there are no claims settled during the year. That is the only thing, because if the assessee is not going to show any of the document to you, you can't do a search. You have to audit based on the information provided to you. So you can get a comfort letter from the management saying that there was no escalation claim during the year or anything settled. But if at all there is anything, then you have to review the papers and quantify the amount. Capital receipt not credited to profit and loss account, I have explained in detail. This is just to the department to check whether all the items which are liable for taxation are being subject to tax in the statement of total income. Otherwise, it's only for information purposes. What is the need to credit a capital to P&L? On sale of fixed assets, it is obviously a capital receipt, but any gain or thing is to go to P&L because that asset ceases to exist from a balance sheet, and any surplus has to go to your P&L. Who is to decide that it is a capital receipt? Management? No, it is as per the accounting standards. We need to see whether the receipt is a revenue receipt or capital receipt based on your company's policy. Similarly, the purchase also, a motor car can be a fixed asset for one entity. It can be a trading item for another entity who is dealing the car business. So that capital or revenue, it depends on the assessee, not on the basis of your management. If a part of term loan for machinery is waived with bank under one-time settlement, if the balance unpaid need to be credited, yes, it has to be credited to profit and loss account. But there are judicial pronouncements that this is not subject to tax. Better take a proper legal opinion and report appropriately. To what extent 50D would apply in addition to 43C and 50C? Independent 43C, as I told you, 43C and 50C, up to 110%, there is no issue. Only if it causes 110%, there will be a challenge for additional taxation. So that we need to check on a case-to-case basis. Depreciation, there is a query how to establish that an asset is ready to put to use. What documentation is required? So if it is a simple computer, we can say plug and play. They can say the data purchase will put to use. So we can get the reference letter from the management or from the user. But if it is the plant and machinery, installation is challenging. We need to see whether it has been attached to the earth, whether the proper power connection has been obtained, whether any approval is required from the local government authorities, if so, whether those things have been obtained. For example, lift, the commissioning report is required. So many things. It depends on the type of asset. We need to see whether that asset has been ready to use and put to use. We need to have proper documentation for that. Where CSR expense is incurred for which both section 35 series and the ATG could be considered, how to report. We can mention the fact appropriately wherever it has been considered. You have to mention the fact. It can't be a dual direction, it can be only one direction. Whether a guarantee commission paid to shareholder employee or being a certain security, the bank is also a commission. Yes, it's a commission. What are the various whether due date are included in days of grace? If by error employee contribution for March 24 got committed to account 23-24, but were paid 15-4. If accounted for 24-25, how to report? Obviously, it will not happen, no, because we'll be doing the tax audit only in the month of September or August. By the time we'll have all the details, we can check this. If it is an omission mistake, then it is treated as period and report appropriately in the financial statements. Is tax audit to do audit of PF ESA records also, whether they are properly directed or account. Yes, as a certificate of financial statements, we need to see whether the directions are properly, but we will not do 100% verification. We do a sample check and see whether the company has a system and control in place. Yes, reconcile. Yes, always do a reconciliation for all the items disclosed in the tax audit report. Have the working papers readily available with proper reconciliations, so that it will be easy for us to clarify. Because nowadays, no QRB is picking up the tax audit reports for review purposes. Because the statutory has gone to NEFRA, QRB include is taking the tax audit report. So we need to have all the details ready. So it will be easy for us to clarify the queries raised. Normally, they will cross verify only from the financial statements because they will check only the tax audit report with the financial statements. They have no privy to any of the records they may ask for your 20 days or a year. Beyond that, there is no scope. So there should not be any mismatch or disconnect between these four documents. So please ensure that all the information reflected in these four items are proper and matches. If there is any difference, have the proper reconciliation available. What is personal expense? How to report the cost is different of a different view. As a personal expense is not directly attributed to the business or the entity. If it is not, you need to discuss RCC and tell them that it is not permitted. If it is material and you are not in agreement, you have to properly mention your taxes. And what is the penalty or fine other than violation of law? Is the levy of breaching? So penalty or fine is always a breach of law. If it is a contract, as always it will be escalation charges or some other terms. It is not a penalty. Obviously, those things are business allowable. Expenditure to provide benefit to a person in violation of law governing him. I'm unable to understand this question. Any corruption to the doctors? No, if the doctor is taking bribe anything in a government hospitals, I don't think that he is legitimate. Obviously, I'm not pushing the comment on this. Whether delayed remittance of TDS individual section 21B since the due date is not mentioned. Obviously, for every TDS item, there is a date mentioned in the statute. We need to mention the date, and if there is a delay, we need to check whether the interest has been paid because we need to report on the interest. Yes, we need to reconcile the TDS recoverable. As I told you, we need to have proper reconciliation statement, basis which only we can proceed further. Basis the reconciliation statement only we will be taking the complaints of TDS return filing and the interest calculation. 48(7) and 43B. 48(7) is applicable only if there is a provision of gratuity, it is not funded. 43B is applicable if the gratuity is funded and approved with the Commission of Income Tax Act. Please note that Commission of Income Tax approval is mandatory for claiming under 43B. Some of the assessees, they will have the gratuity fund, but it is not approved by the Commissioner, then it will not get the benefit of 43B. Though you are going to make a payment to LIC, normally it will be a tripartite agreement. The LIC will ask you to file application to Commission of Income Tax to get approval. If you miss this, then you are not entitled to claim 43B. It will come under only 48(7). So if it is 48(7), we need to have a reconciliation of opening balance, what is the amount provided in here, what is the amount settled, and what is the closing balance. Amount settled can be claimed as deduction. If it is approved fund, then what is the opening balance, what is the amount provided, what is the amount transferred to LIC or any other trust. That amount can be claimed because the payment to the employees will be paid from the trust. If an additional amount paid from the company, that also can be claimed as a charge to P&L. But there is a difference between only if it is approved fund, you can claim on payment basis to the trust or LIC. If it is unapproved, then it is always 48(7). Only on payment to the employee on the retirement of otherwise, we can claim as a reduction, not before that. How to get information regarding contingent liabilities? We have to review all the acts applicable to the company. For example, Income Tax Act, GST Act, what may be, what is the communications return filed, what are the communications done. Now, with the electronic portal, we can access the details of order cost. So obviously, we'll have some comfort nowadays as compared to the earlier years where we need to rely only on the papers produced by the SIC. But now we have some additional information. But better to get a manager representation also that other than those disclosed to us, there are no other conditions. How to get the correct information regarding MSME? See, MSME is the obligation of the SIC, not on us. So when they are onboarding a customer or supplier, they need to get the status of the customer as MSME. If it is classified, they have to classify as MSME, and we have to check whether the payment has been made within the specified date as per the statute or the interest has been funded. And it is obligation for the party to communicate if there is change in the status. It is not on the obligation for the auditors or the company. So the system has to take care, not nothing from further from our end. Uh, 16D, what is the difference between 16D and difference 269? I already clarified. So this is regarding for only transaction, irrespective amount we need to give. For 269 is only for more than 20,000 rupees. And if it is cash, it will be taxed in 269 under 100%. But 16D, irrespective of the amount, we need to give the details. how to compute the interest on TP secondary adjustments. So there is a process mentioned in the section on rules. It is to be computed, and accordingly we need to ensure that the amount is realized. Two scenarios: what is the squaring up of a loan, and what is the significance? There is a debit and credit balance. The party agrees, then definitely it can be adjusted, provided the amount of payment is also by permitted mode. Dot product losses and depreciation, I explain detail. If there is any query, I'll be happy to answer. Capital direction, if it is payment is made from personal bank account, if you are going to be auditor only for the business and not for thing, then we can mention the fact in the thing. This is because it will be filed by the statement of total income, and which we are no privy. There is no obligation that you have to compulsory mention the direction permissible under chapter 6A if there is not to the root of accounts and that is not written in the P&L account. Quantity particulars, yes, yield, we need to have the workings and we need to mention the percentage. It will help the asking officer to compare with the previous year. Quantity, as I told you, it's only for principal items. Obviously, the details will be available in the company and we need to have the details. 222E, it is one of the risky area. We need to have proper documentation. If you are going to take standard that is not liable for taxation risk in 222E. Other things I have covered, I think all the queries, I think this person has been answered. If anything specific, I'll happy to answer. You can type in the chat box or you can ask me directly. One question from Mr. Vijay Kumar. In case of retail business, it is not possible to give quantity details as the deal in numerous items. What is the solution? See, obviously, I told you it is only for principal items. If the person is dealing retail items, you have to filter down what is the top 5 items or 10 items. Definitely, all items will not be in a lesser quantity. The entity would be handling certain items in bulk. So those items we can do. If suppose all the items are insignificant and nothing is primary, then you can mention the fact in the report. Can we give a disclaimer in clause 44? It's not advisable. If the assessee is not giving details, you have to give a disclaimer, and obviously you have to disclaim your tax audit report is also Form 3C or CD. So, but there is no harm in that, but better you get the details. Otherwise, there is no purpose for the assessee. Now, for 3CB, if the assessee is not creating any provision for gratuity or leave encashment, you can mention the fact in your report. As a qualified report, the standard is not complied with. We have no other option. We can't compel the assessee because I also facing a case. If the amount is quantified in the books, the client feels that the employee will demand that amount, which they are not prepared to make the payment. In that case, we have to qualify the report. Any other queries? I think I have answered. The main phase of the report is we can qualify that because it's a non-compliance of the standard that is statute to mention the main part of this.
Hello.
Yeah, yes, Mr. Radish.
Sir, good evening, sir.
Good evening.
Sir, I have one query. I have some 2-3 queries. First query relating to the depreciation is there, right, sir? For example, if a company is eligible to take additional depreciation, so if I purchase a machinery and I kept in the plant in the factory premises, if I incur the installation expenses relating to the machinery, then I can claim additional depreciation on those installation expenses also, sir?
All items up to the stage the machinery is put to use, all expenditure is entitled for additional depreciation.
Okay, friends. So that is first query. Second query is relating to the carry forward of losses, sir. For example, I have filed a return, but it was not a assessed because it may be transferred to local jurisdiction office or something. It happened. Then can I claim? Can I carry forward the loss which I had claimed in the return, or should I wait for the assessment to complete, sir?
No. As per the return, you can claim. If at all at a later date the assessing officer disallows the loss, then automatically subsequent returns will be revised. So you have to go basis the paper available with the assessee. If you have filed the return for 24-25, 25-26, we are filing the tax audit report. Order is not available for 24-25. You can take the loss as per the return of 24-25. No issue.
Okay, sir. Thank you. Thank you so much, sir. Thank you.
Any other questions? Nothing. I'll request SIRC to take over, please. Yeah, we'll share the slide with the institute. They'll share it. No issue. Any queries if you have, we can send a mail to the institute. They'll send it to me. I'll answer that also. Not issue.
Okay, sir. We will close the session. Thank you. Thank you all. Thank you, sir. Thank you.
Thank you very much. Thanks to all the participants for the patient hearing. If at all you require any further clarifications, please feel free to ask me. My email ID is available in the presentation. I'll be sharing. So I'll be happy to answer any further questions if you have any questions. Thank you. Have a nice evening. Happy tax audit season.
Thank you, sir. Thank you for your valuable session and time and effort, sir. Members, but tomorrow also on the same timing, a tax audit program is there. So please join through the same link which we have shared today. And 8th program is actually rescheduled to the 11th October. So 11th October via the same link, again you can join to the program. Anyhow, every day we will also send the link to you, but the same link also can be used to join the program. Thank you.
Thank you. Thank you.